Good morning, I'm Prashansa Baniya, and today I'll be presenting an in-depth evaluation of Summit Trails Coast project. This is the table of content for this presentation. Summit Co is a luxury Himalayan travel project over in 5 years. The payback period is 3 years and 8 months. The NPV is £2.79 million, indicating strong profitability. Funding options are venture capital, angel investors, etc. Bank accesses financial stability, collateral, and repayment capacity. Introduction of the case. Summit Trail Co. offers luxury Himalayan expedition and is launching a 5-year premium travel package with helicopter tours, upscale accommodation, and tailored services for elite clients. WACC. Weighted average cost of capital is the amount of money it must pay to finance its operations. Why is WACC essential? WACC is essential indicator for investors to evaluate a company's profitability prospects. Calculation of WACC and its individual components. Summit Trail Co's WACC is 7.14% lower than past WACC, making the project cheaper to finance. The cost of equity is 6.67%, reflecting shareholder return expectation, and cost of debt is 8.33%, representing borrowing costs. Summit Trail Co's market equity is 9, with debt at 3.60. The equity and weight debts are 71.40% and 28.57%. The net cost is calculated by multiplying each component's cost by its weight, 4.76% for equity, 2.83% for debt, and these are summed by calculating the overall WACC. These are summed to calculate the overall WACC, crucial for evaluating profitability. Projected cash flow for the next 5 years. Summit Trails Co. invests $6.05 million in its luxury project. Revenue is driven by clients' volume and pricing starting at £5 million in year 1 but declining to £4.75 million by year 5. Variable costs rise with client numbers while fixed costs remain steady at £1 million. Marketing at $500,000 with pilot salaries increasing 2% annually. EBIT is calculated by summing revenues and expenses with depreciation reducing EBIT but added back for cash flow calculations. Despite declining client numbers, the project generates positive cash flow annually. In year 5, additional cash inflows from £1 million in working capital recovery and £1.57 million from helicopter salvage boosts profitability. Calculation of NPV and payback period using the calculated WACC. Summit Trails Co. recovers an initial investment of $6.05 million in 3 years and 13 days, indicating strong early cash inflows. However, this method doesn't account for the time value of money. With the time value of money considered, the discounted payback period is 3 years and 8 months, still within the 5-year project lifespan. A positive NPV of $2.79 million confirms profitability, suggesting the project will exceed the required return and align with the company's goals of increasing shareholders' value. Now using the historic WACC. The discounted payback period is 4 years and 236 days, reflecting a longer recovery time due to higher capital costs, but still within the 5-year project. The NPV of 519,040.47 indicates project's high adds value, though less attractive compared to the previous NPV of 2.79 million. The financial metrics show the project is viable and should move ahead, but monitor market demands and client satisfaction. Analysis of the 4 investment appraisal techniques. NPV measures investment profitability by comparing the value of cash inflows and outflows. Advantages are considers time value of money, cash flow timing, and all relevant cash flows. Preferred for its realistic assumption and clear impact on the firm. Disadvantages are difficult to select the discount rate, determine cost of capital, and access investment size. Next slide, we have IRR. IRR measures profitability by finding the rate at which NPV equals zero. Advantages are easy to calculate and compare projects, considers the time value of money. Disadvantages are ignores project size and future expenses, assumes reinvestment at IRR. Next slide, payback period. The payback period measures the time needed to recover an investment. Advantages are simple and easy to calculate, helps compare project with shortest payback time. Disadvantages are ignores the time value of money, excludes cash flows after the payback period, doesn't fully consider risk, favoring short-term projects. ARR measures the average annual accounting profit as a percentage of the initial investment. Advantages are it's easy to calculate and understand, helps compare projects' profitability and performance, useful for small time investors. Disadvantages are ignores the time value of money and cash flow timing relies on average investment and accounting profit. Larger businesses prefer NPV and IRR over ARR. Funding option for the companies. Venture capital firms fund startup in exchange for equity. In Nepal, examples of venture capitals are Dolma Impact Fund, Business Oxygen, and IME Group. Advantages are access to large capital, strategic guidance, no immediate repayment. Disadvantages are loss of equity and control, high growth expectation, and competitive process. Next slide, we have angel investors are high net worth individuals who provide early stage funding in exchange for equity. Examples are Nepal Angels Network and Bidwa Ventures. Advantages of are flexible investment terms, mentorship and guidance, no debt repayment. Disadvantages are smaller investment size, equity dilution, not suitable for all businesses. Short-term loans provide quick funds for immediate cash flow needed, often used as working capital. Advantages are fast access to funds, covers short-term expenses, flexible borrowing options. Disadvantages are higher risk interest rates, risk of dependency, requires strong credit history. Bootstrapping involves using personal savings or reinvested profits to fund a business. Advantages are full control, no debt or investor pressure, encourages financial discipline. Disadvantages are limited capital, slower growth, higher personal risk or financial risk. Next slide, we have a bank considers loan after evaluating several factors before approving a loan. They review key documents like company registration, tax clearance, PAN, MOA, AOA, and shareholder details. Financial health is evaluated through audit reports, profitability payback period, NPV ratios, cash flow trends, and future projections. Bank protections banks seek are collateral such as property, gold, or shares is required for security, with owners providing personal guarantee. Collateral must be valued and insured. A CIB report checks the company's loan history. Loans are denied if the company or shareholders are blacklisted or the loan is substandard. If all criteria are met, the loan is approved. To conclude this presentation, Summit Trails Co. should proceed with the project due to positive NPV, early payback, and strong financial viability. Ongoing monitoring of markets and demand costs is crucial alongside with exploring optimal fund options. Thank you very much. These are the references for this project and the appendix.